everyone. Welcome to Wealth Redefined. I'm your host, Michael Reynolds, certified financial planner and owner of Elevation Financial. Thanks for joining me today. Today's topic is, what is a Roth conversion and how do I use it? So if you've been exploring ways to optimize your financial plan or your retirement plan, you've probably heard the term Roth conversion. You might be wondering if it's something you should be doing, or maybe not even sure what it means in the first place. So we're going to talk that over today. So Roth conversion can be a pretty powerful tool in the toolkit of financial planning. But like most things, most tactics, it's not right for everybody. And the timing really matters as well. So let's break down what a Roth conversion actually is, how it works, and whether it might make sense for you. So first of all, the basics. What is a Roth conversion? A Roth conversion is the process of moving money from a traditional retirement account into a Roth IRA. You're basically converting pre-tax retirement savings into after-tax retirement savings. The most common scenario involves converting funds from a traditional IRA to a Roth IRA. However, you can also sometimes convert money from other pre-tax retirement accounts like 401ks, 403bs, or other similar employer-sponsored plans. Here's what makes this conversion significant. Traditional retirement accounts are funded with pre-tax dollars. You get a tax deduction when you contribute if you qualify, but you'll pay ordinary income taxes when you withdraw the money in retirement. Roth accounts work in reverse. You pay taxes on the money going in, but qualified withdrawals in retirement are completely tax-free if you meet the requirements for tax-free withdrawals. When you do a Roth conversion, you're choosing to pay taxes now rather than later. You're moving money from the pay taxes later bucket into the pay taxes never again bucket. So how does a Roth conversion actually work? The mechanics of a Roth conversion are pretty straightforward, though the tax implications are what really matters and require some consideration. So you start by deciding how much you want to convert. You don't have to convert your entire traditional IRA balance. You can convert any amount you want to, from a few $1,000s to the entire account if you want to. Next, you'll contact your financial institution and request a conversion. Although most major brokerages make this pretty simple online, you can just go online, click a few buttons, and do the conversion online. If you have accounts at different institutions, you can still do the conversion, but it might involve more paperwork because they're at different places. So the money moves from your traditional IRA to your Roth IRA. If both accounts are at the same institution, this typically happens immediately. If they're at different places, it might take a few days. Here's the important part. The amount you convert is added to your taxable income for that year. If you convert $50,000, that's an additional $50,000 of income you'll report on your tax return. The tax bill is due when you file your taxes for the year in which you did the conversion. That's why the timing and planning are really important for this. So, when does a Roth conversion make sense? So Roth conversions aren't universally beneficial. They work best in specific situations where the math and the circumstances align in your favor. So one circumstance could be you're in a lower tax bracket than you expect to be in retirement. This is probably the most common reason to consider a Roth conversion. If you're currently in a lower tax bracket than you anticipate to be in during retirement, paying taxes now could save you money in the long run. This scenario often applies to people earlier in their careers who expect their income to grow substantially. It can also apply to business owners during a slower year or anyone experiencing a temporary dip in income. Although be aware that tax brackets aren't everything. You have to look at your effective tax rate, not just your tax bracket. So keep that in mind when you're making the comparison. Another possible scenario in which this can make sense. You're between jobs, or maybe you're retired early. If you've left a job and you haven't started a new one yet, or if you've retired before you need to start taking withdrawals, you might find yourself in an unusually low tax bracket. This creates a window of opportunity for conversions. Some people strategically plan early retirement specifically to take advantage of these lower income years for conversions. Also, maybe you want to reduce future required minimum distributions. Traditional IRAs come with retired minimum distributions, also called RMDs for short, once you reach a certain age. These forced withdrawals can push you into a higher tax bracket, can trigger Medicare premium surcharges, and affects the taxation of your Social Security benefits. Roth IRAs don't have RMDs during your lifetime. By converting traditional IRA money to a Roth, you reduce the balance subject to RMDs, giving you more control over your taxable income in retirement. Also, maybe you're planning for estate tax efficiency. If you're planning to leave retirement assets to your heirs, Roth accounts can be more tax efficient. Your beneficiaries will inherit a Roth IRA and can take distributions tax free, whereas inherited traditional IRAs require beneficiaries to pay income taxes on those withdrawals. And recent changes to inherited IRA rules have made this consideration even more important. Most non-spouse beneficiaries now have to empty their inherited retirement accounts within 10 years, which can result in a pretty big tax burden if the account is in a traditional IRA. Also, if you believe tax rates will increase in the future, some people do Roth conversions based on the belief that federal income taxes will rise in the coming years. Whether you think this depends on your point of view of fiscal policy, budget deficits, all sorts of things. But if you believe tax rates will increase, locking in today's rates through a conversion could make sense if that aligns with your belief system. All right, what are the advantages of Roth conversions? Some advantages are tax-free growth forever. Once the money's in a Roth IRA, all future growth is tax-free, assuming you meet the requirements for qualified distributions. If you convert $50,000 today and it grows to $200,000 over the next 20 years, you'll never pay taxes on that $150,000 in growth. That's really powerful if you have a long time horizon, especially. The longer the money can grow tax-free, the more valuable the Roth conversion becomes. Also, it gives you flexibility in retirement. Roth IRAs give you more flexibility to manage your taxable income in retirement. You can strategically withdraw from Roth accounts in years when you want to keep taxable income lower, maybe to avoid Medicare surcharges or stay within a certain tax bracket. This flexibility is even more valuable when combined with other income sources like Social Security or rental income, for example. Also, no required minimum distributions. The absence of RMDs during your lifetime means you're not forced to withdraw money you don't need. This lets your money continue growing tax-free for as long as you live. Also, it gives you protection against future tax increases. A Roth conversion basically locks in today's tax rates. So whatever happens to tax policy in the future, your Roth IRA won't be affected, in theory. The money is already taxed and future withdrawals are tax-free. All right, what about the disadvantages of Roth conversions? So as attractive as they sound, there are some drawbacks you need to be aware of. One is the immediate tax bill. That's the most obvious. Converting $50,000, for example, means adding $50,000 to your taxable income for that year. Depending on your tax bracket, that could mean a substantial increase in your tax bill. If you don't have cash available outside of retirement accounts to pay this tax bill, a conversion becomes much less attractive. Using funds from the conversion itself to pay taxes reduces the amount that can grow tax-free and might trigger additional penalties if you're under age 59 and a half. Also, potential to push you into higher tax brackets. A large conversion can push you into a higher marginal tax bracket. And the US tax system is progressive, which means different portions of your income are taxed at different rates. So a conversion could cause some of your income to be taxed at rates higher than you typically pay. Also, it can impact other benefits. So higher income from a conversion can affect lots of different tax benefits and credits. It might reduce your eligibility for certain deductions, increase your Medicare premiums through income-related monthly adjustment amounts, or IRMA for short, or affect your child's eligibility for financial aid. The Medicare premium impact is particularly important. If your modified adjusted gross income exceeds certain thresholds, your Medicare Part B and Part D premiums can increase substantially, and that increase is based on income from 2 years prior, so you can apply it accordingly. Also, it's irreversible. So prior to 2018, you could recharacterize a Roth conversion, which is basically undoing it if you changed your mind. However, that safety valve no longer exists. Once you complete a Roth conversion, it's permanent. Also, potentially the uncertainty of future tax rates could be a concern. While many people convert based on assumptions about future tax rates, the reality is that we don't know what tax rates will be in 10, 20, or 30 years. If rates actually decrease or stay the same, you might have paid taxes unnecessarily early. There's also the opportunity cost. The money you pay to pay the taxes on the conversion is money you can't invest elsewhere. There's an opportunity cost to paying taxes now instead of investing that money and letting it grow. For this reason, Roth conversions generally make the most sense when you have cash available outside of retirement accounts to pay the tax bill. Also, another disadvantage is the 5-year rule for Roth conversions. When you convert funds from a traditional IRA to a Roth IRA, you trigger a 5-year waiting period for each conversion. This period begins on January 1st of the conversion year. While you pay income tax on the converted amount at the time of conversion, the 5-year rule creates an additional layer of restriction on accessing those funds. The main disadvantage is the potential 10% early withdrawal penalty. If you withdraw converted amounts, both reaching age 59 and a half and completing the 5-year waiting period, or before both those things happen. So before reaching age 59 and a half and before you complete the 5-year waiting period, the IRS will assess a 10% penalty on the taxable portion you converted. This penalty applies even though you already paid income tax on the conversion. So it's on top of that. Each conversion starts its own 5-year clock. So multiple conversions means tracking multiple waiting periods. And that rule is really designed to maintain the retirement-focused purpose of these accounts while still allowing the tax benefits of a Roth conversion for long-term planning. All right, let's talk about state taxes. So in the big picture, state taxes matter too. So if you live in a state with income tax, which most of us do, you'll owe state taxes on the conversion in addition to federal taxes. And that can be anywhere from 3% over 10%, depending on your state. And that adds to your total tax bill. So keep that in mind based on the state you live in. So let's talk about the timing of Roth conversions. The timing of Roth conversions matters for tax planning. You can do conversions anytime during the year, but you might want to wait until later in the year when you have a better sense of what your total income is going to be. This helps you avoid accidentally pushing yourself into a higher tax bracket than you anticipated. Some people do a series of smaller conversions over several years rather than just one large conversion. And this strategy is sometimes called bracket filling. You're basically filling up a certain tax bracket. And that involves converting just enough each year to stay within a target tax bracket. So is a Roth conversion right for you? Given all these factors, how do you decide? So start by looking at your current tax situation. What's your marginal tax bracket this year? Do you have any unusual deductions or credits that might lower your taxable income? Think about your future tax situation. Sometimes it requires some educated guessing, but look at things like expected retirement income, pension payments, Social Security benefits, and whether you'll have other taxable income in retirement. Look at your timeline. Roth conversions become more valuable the longer your money has to grow tax-free. If you're converting at age 40, you potentially have decades of tax-free growth ahead. If you're converting at age 70, the math is different. Ask yourself about cash flows. Do you have money outside of retirement accounts to pay the tax bill? If not, the conversion becomes much less attractive. Think about estate planning. Do you plan to leave money to your heirs? Does a Roth IRA fit better into those plans? Also, don't forget to get outside advice from professionals. So, consider working with a financial advisor and or a tax professional, and they can help you with some of these questions as well. So a Roth conversion isn't an all or nothing decision. It's a tool that can be used strategically and can be part of your broader financial plan. Many people do partial Roth conversions each year, converting just enough to fill up a current tax bracket without spilling to the next one. And that systematic approach can be really effective during early retirement years before Social Security and RMDs begin. Other people look for specific opportunities like years with lower income, market downturns that can reduce account values, or times when they have a lot of deductions available. The key is to view Roth conversions not as a one-time decision, but as an ongoing strategy that you revisit on a regular basis based on life circumstances. So think about your tax situation, your retirement timeline, and your financial goals. And these things will evolve over time. So the flexibility and the tax-free growth that Roth accounts offer can be really, really valuable, but only if you can decide that the price of admission makes sense for where you are today and where you want to be down the road. All right, let's wrap up with some frequently asked questions about Roth conversions. So 1, can I convert my 401k to a Roth IRA? Yes, but with some restrictions. If you're still working for the employer that sponsors your 401k, you typically can't convert those funds unless your plan allows in-service distributions, which many plans don't. However, once you leave that employer, You can roll your 401k into a traditional IRA and then convert it to a Roth IRA. Some plans allow direct conversion to a Roth 401k if your employer offers that option as well. So it really depends on the plan. Is there a limit on how much I can convert? No. Unlike annual Roth IRA contribution limits, there's no limit on how much you can contribute, or how much you can convert in a given year. You could convert the entire balance if you want to from your traditional IRA, but you'd have to pay the taxes, obviously. So that said, just because you can convert any amount doesn't mean you should. Converting too much at once can push you into higher tax brackets and trigger other tax consequences that we've already discussed. Next question. Do I have to convert my entire IRA at once? No. You can convert any amount you want to, from a few $100s to the full balance. Many people find it more strategic to do partial conversions over several years to manage the tax impact. That approach gives you more control over staying within certain tax brackets and spreading tax burdens across multiple years. Next question. Can I convert a Roth 401k to a Roth IRA? Yes, because this is not actually a conversion, it's a rollover. This is generally a straightforward process since both accounts are already Roth accounts. The good news is this type of rollover doesn't create any taxable income since the money's already been taxed. It's both Roth accounts. So many people do this when you leave an employer to consolidate accounts and gain more investment options. And this is generally only available once you leave your employer, unless your plan offers in-service withdrawals. All right, what if I can't afford to pay taxes on the conversion? If you don't have cash outside your retirement accounts to pay the taxes, you might want to reconsider. Using money from the conversion itself to pay the taxes defeats much of the purpose. You'll be reducing the amount that grows tax-free if you're under 59.5, the portion used for taxes could be subject to the 10% early withdrawal penalty. So consider smaller conversions that you can afford, or wait until you have cash reserves that are sufficient to cover the bill. Next question. When is the best time of year to do a Roth conversion? You can do a Roth conversion anytime you want. However, many people wait until later in the year, often in the fourth quarter, when they have a clearer picture of total annual income. The timing helps you avoid accidentally converting too much and pushing yourself into a higher tax bracket than you meant to. And it can give you more time to save up and pay the tax bill as well. Can I reverse a Roth conversion if I change my mind? No. Since the Tax Cuts and Jobs Act of 2017 went into effect, Roth conversion recharacterizations are no longer allowed. Once you complete a conversion, it's permanent. So that makes it even more important to carefully consider the decision and run the numbers before converting. How does the Roth conversion affect my Social Security benefits? The conversion itself doesn't affect your benefit amount. However, the additional taxable income from the conversion could cause more of your Social Security benefits to be taxable in the year you do the conversion. Up to 85% of your Social Security benefits can be taxable depending on your combined income. A large conversion could push you into this range temporarily. Next question. Will a Roth conversion affect my Medicare premiums? Potentially. Medicare Part B and Part D premiums are based on your modified adjusted gross income from 2 years prior. If a conversion pushes your income above a certain threshold, you could face income-related monthly adjustment amounts, or IRMA, which increases your Medicare premiums. Do I pay the conversion tax all at once? Yes. The tax on Roth conversion is due when you file your tax return for the year in which you did the conversion. You can't spread the tax liability over multiple years. However, you may need to make estimated tax payments throughout the year or adjust your withholding to avoid unnecessary underpayment penalties. So your tax professional can help you determine if that's necessary. What happens to my Roth conversion if the market drops after I convert? Well, you still owe taxes on the full amount you converted. Even if the value drops afterward, you still owe the taxes because it's what you converted that you pay taxes on. So it's a risk. For example, if you convert $50,000 and the market drops so the account is worth only $40,000 a month later, you still owe taxes on the full $50,000 amount you converted. And that's why some people prefer to convert during market downturns when the account values are already lower than normal. Can I do a Roth conversion if I'm still working? Yes, there's no requirement that you be retired to do a Roth conversion. However, being employed usually means you're in a higher tax bracket, so that might make Roth conversions less attractive. Some working professionals still do conversions if they believe they'll be in a higher tax bracket in the future, or if they want to start the 5-year clock for certain Roth withdrawal rules. Should I convert before or after retirement? Depends. On your tax situation, many people find that the years immediately after retirement, but before RMDs and Social Security begin, are ideal for conversions. During these years, you might be in a lower tax bracket than during your working years. However, if you expect to be in a lower tax bracket during retirement than you are now, it might make sense to wait. Everyone's situation is going to be different. Can I do a Roth conversion if my income is too high to contribute directly to a Roth IRA? Yes, there are no income limits for Roth conversions, only for direct Roth IRA contributions. High earners often contribute to a traditional IRA, getting no deduction since they're above the income limits, and then immediately convert to a Roth IRA. This is called a backdoor Roth IRA contribution. However, the pro rata rule can complicate this strategy if you have other traditional IRA balances, so be aware of that. Which leads to our next question, which is, what is the pro rata rule? The pro rata rule determines how much of your Roth conversion is taxable when you have both pre-tax and after-tax money in traditional IRAs. The IRS requires you to convert a proportional amount of both. So, for example, if 90% of your total traditional IRA balance is pre-tax money and 10% is after-tax contributions, any conversion will be 90% taxable and 10% non-taxable, regardless of which specific dollars you convert. And this rule considers all of your traditional IRAs in aggregate, including traditional IRAs, SEP IRAs, and simple IRAs. It combines them all together. Next question, will a Roth conversion affect my financial aid eligibility? It can. The additional income from a Roth conversion is reported on the FAFSA and can reduce financial aid eligibility for the following academic year. So if you have a child approaching college age, you might want to time the conversion for years that won't impact financial aid, such as before your child is in high school or after they've completed college already. Can I convert an inherited IRA to a Roth IRA? Generally, no. If you inherit a traditional IRA from someone other than your spouse, you cannot convert it to a Roth IRA. You must take distributions according to the IRS rules for inherited IRAs. However, if you're a surviving spouse, you have the option to treat the inherited IRA as your own. And once you do this, you can then convert to a Roth IRA if you want to. And then finally, how do state taxes affect Roth conversions? If you live in a state with income tax, you'll owe state taxes on the conversion in addition to federal taxes. That can add to your tax bill as well. Some people even consider moving to a state with no income tax before doing a large conversion, although that requires some planning and usually only makes sense if you're planning to move there anyway. It's kind of a big deal to move to a new state. So, if you're going to do it anyway, that's a consideration. A few states don't require or don't tax retirement income at all, and others have special provisions for it. So you got to look at your state individually and go case by case. All right, that is your frequently asked questions to wrap it up. So when it comes to Roth conversions, a lot to consider. Keep all this in mind. And as always, feel free to reach out if you have questions. You can find me as always on my website, which is elevationfinancial.com. And you're welcome to reach out or book a free consultation if you want to chat further. Thanks for joining me today. Have a great day. We'll see you next time.